The 10-year Treasury yield hitting its highest level since '07. And my next guest thinks it could rise above 5. Joining me now to discuss, Chris Verrone, head of technical and macro research at Strategas Research Partners. Welcome back.
Great to be here.
North of 5%.
Yeah.
To where?
510, 520 is the target from the breakout. So if you look at the range we were in for much of the last year and just project that forward, you get 510, 520. But let's not complicate this. We're in a business of trends, and until the market says otherwise, the trend is higher. So I think more important than whether it's 510 or 517 or 522, it's higher until the market says otherwise. What's remarkable to me is, despite how persistent the move in yields have been, if you survey the economists on the street, 48 economists submit yield forecasts to Bloomberg every week. None of them, 0, have a forecast above 5% for the end of this year. It's 30 basis points away, Scott.
Yeah. What makes you think we're going to get there? I understand trends, but that doesn't really...
I think there's been every opportunity over the last 4, 5, 6 weeks, I mean, even this weekend, for the bond market to catch a bid with the debt deal in Washington. Mm-hmm. And everything you throw at this, there's more sellers than buyers. I think it reflects the massive amount of supply that's out there. I also find it notable, the parts of the market I would expect to work if rates were going to fall continue to be for sale, whether it's staples or utilities, et cetera.
You feel like, I mean, I'm almost getting to the point where I feel like there are quickly becoming too many people on the same side of the too much supply, no buyer boat. So rates are just going to continue to shoot higher.
I think the twist I would look for is when the flows into the bond products stop. It just seems so inconsistent to look for a high in yield when everyone's still chasing bonds. And I think the irony is many in this business waited their whole career for bond yields to start going up. And now that they've started going up, everyone's so eager to buy them. It's a remarkable change in psychology over the last 30 or 40 years.
Yeah. What about stocks then? So if you're right, and we're talking about 5+%, 5 is going to be that psychological level that people maybe get freaked out. I don't know. But what do stocks do if we get to 5?
It's funny, I looked at a bunch of charts this weekend and I wrote one note down to myself. I said, if this is a bull market, what's a bear market look like? Because there's a lot of bad charts out there. I recognize the big weights have kind of kept the indices above the fold here. But when you go kind of name by name, only 40% of the S&P is above the 200. So I recognize where we are seasonally. I recognize we're probably tactically oversold. But that's not the big story to me. The big story is we're very weak from a foundational perspective under this market. I think rallies from here are sell-up events. Use them to sell strength.
You're looking at Nvidia is one of the specific stocks you mentioned. We mentioned, all of these mega cap tech stocks are up today in the face of rising yields, which we haven't always seen.
Sure.
Why would you be a seller of strength in Nvidia specifically?
I think when you look at how they've attacked all the weak stuff in this market, right? They've thrown out the utilities, they've thrown out the real estate names. It's almost capitulative with the bad stuff. I wonder if they start to go after some of the good stuff here. And, it's funny, we talk about semis or tech or discretionary in such vaunted terms. But also, when you kind of peel back the onion and look away from those 4 or 5 big names that are working, it's not much better for tech discretionary semis under the surface. Only, I think, 35% of semis are above the 200. So it's
discretionary has been completely skewed by Amazon and Tesla.
Oh, sure.
Or totally get it.
And Scott, what's remarkable is this pair between, say, discretionary and energy. We look back at the 3 prior soft landings in history, 94, 84, and 67. If soft landing's the right call, discretionary should turn up meaningfully here, and it should be broad. So the fact it hasn't, I think, raises some questions there.
It's funny. I'm looking at the list of your sector rankings, and utilities at the bottom.
Yeah.
Now, you don't have to be a rocket scientist to understand that, as rates are going up, and you suggest they're going up even more, why it would fall to such a degree that it has in your own ranking list. But what do you make of what we're watching today? It's jarring.
I think that price action today is the first time in this whole utility move where there's a hint of capitulation here. I mean, you're doing, I think, 45, 46 million shares on the XLU. Maybe the average is 10 or 12. So it's the first day where you've seen, I would say, some panicky volumes there. What I want to watch for, and think about fall of 2018, that last leg up in rates, you actually started to see the defensive like utilities outperform. That's a bad message. So I think be on guard here for some type of a bounce in Utes and staples. We know how bad they are. Today's the first day that looks pretty capitulative.
Energy is the top holding.
Yeah.
Why?
95% of them are above the 200. Everything we've thrown at them for the last 2.5 or 3 years, they've brushed off. It's funny. This was such leadership for 2 years. It took 6 months off, and everyone forgot about it. I love the paradox of the 3% CPI print on July 12th of this year re-engaged this group. It's global, it's the services, it's the integrateds. They've come off the last week or so. I think it's a consolidation. I'd be a buyer of weakness in energy.
Good seeing you. Thanks for being here. Yeah, Chris Verrone, Strategas, joining us here at Post 9.